all the panelists to be kind enough to share their brief introduction, because we have got some investors as well as an entrepreneur on the panel. And they're going to talk about how capital meets builders and how India is further going in the entrepreneurship arena. So Adil, if I could first start with you.
Thank you. So my name is Adhil Shetty. I'm now an entrepreneur for 18 years. So the company is called Bank Bazaar. We help connect consumers and banks. I think for us, India's been an incredible market where you're constantly dealing with change. I was just chatting earlier with Piyush, and he was asking me what's new. And I was just saying that, where a business which traditionally has worked with banks, and we've built annuity revenue streams via co-branded credit cards, loans. But of late, we've realized that, there's a business opportunity in serving consumers with services on how to improve their credit score. So we launched a product about 6 months ago. It's got 1 million sign-ups where people are paying 100 rupees a month to get a credit score doctor. And we're generating 1 million videos every month using AI, no human involvement. So it's a crazy ride to be an entrepreneur. And it's good to meet with the capital providers because we go hand in hand, and very excited to have this conversation.
Sure. Subeer.
Hi, good afternoon, guys. I know this is a pre-lunch session and you guys will be very hungry. So we'll keep it, we'll try and make it entertaining for you. My name is Subeer Monga. I've been doing venture investing out of Bombay for about 16 years now. Currently heading a firm called Sorin Investments. We're a 1,350 crore fund. We do Series A, Series B investing, 40 to 80 crore check sizes, and agnostic, consumer, financial services, enterprise across the board.
I'm Vinod, Murali. I've been giving debt to startups for about 18 years now. And about 9 years ago, ventured out as an entrepreneur myself, started Alteria Capital. So we've backed more than 250 interesting Indian startups. And it's been a pretty interesting ride to see evolution across sectors and stages over more than 15 years now. And I believe the real magic is yet to happen. So great to be here. Thank you.
Good afternoon, everyone. This is Piyush Bansal. I head Aditya Birla Ventures, investing across tech, consumer, Series B and beyond. India, US, largely tech-oriented and consumer teams. 12 odd investments, pretty gung-ho about the whole Indian entrepreneurial journey right over the last 15 odd years. So we'd love to, looking forward to the discussion.
Thank you. Thank you for the kind introduction. And Adil, if I could start with you first, and because you operate in a space which is largely very much regulated by all the bodies, the RBI and various kind of policies we see in place. And last year, of course, has been quite tough for fintech. So what kind of growth cycles have you gone through? What have been your learnings as an entrepreneur?
So, I think what I get excited about is what Vinod just mentioned. In spite of the entire journey we've been through, we still know that India is at day one, right? Recently, I was traveling through China, and if you look at how much growth, how much development, how much opportunity India is going to have in the next 10 to 20 years, it's unimaginable. Now, in fintech specifically, I think one has to understand what is the opportunity and the regulatory mindset, because you touched upon that. And, I'm sure that everyone here has investments in fintech. I feel that the Indian regulator has a view that I put out a regulation and you stick to it in black and white, and there's no question of gray. Now, different regulators might feel differently. So in the UK, for example, the regulator might say, as long as you don't break a rule, you're an innovator and you're moving things forward. But in India, it's black and white. So if I say, yes, do it, don't operate in the gray. So I think as long as you comply with that, the opportunity exists. I think every 5 years is a incredible new opportunity. And what we feel as a company is it's continuous learning, right? So 2 years ago, we would not have imagined what AI is doing to our business. I'll give you a couple of small examples. So typically in India, you go through a video KYC process for a credit card or a loan, and you need someone to assist you because you need a PAN card and Aadhaar card. Today, right, an AI agent is doing all of that. So we have 250 seats which are AI agents. They're highly compliant, they're highly auditable, they never missell, and they get the job done. Who would have imagined 2 years ago that 250 seats would be occupied by AI agents? we used to have a 5-member campaign team. So we have a database of 70 million consumers, and a 5-member campaign team would run 20 campaigns a month and test out what would work. Today, an AI sets up 5,000 campaigns and is continuously improving which language do people respond better to, which graphic, which reference, and no human can operate at this scale. So what we're realizing is AI is not about replacing a human, it's about building a new system the way you never could have imagined before, and it's a continuous learning experience.
Sure. Subeer, if I could come to you, which are the sectors you're now excited about? And are there still segments which you're backing, which you think, regulations plays a much more bigger role, or you're backing sectors where an AI has actually taken the leap?
I think as a firm, as a philosophy, and as a market, I think India still is not deep enough for you to be sector specific at the early stage, in my view. Especially for the check sizes that we play in. So we're very horizontal. So if I give you a construct of our portfolio, we've got 2 financial services companies, we've got a consumer D2C brand, we've got 8 enterprise companies. Out of those, 3 are non-AI, 5 are AI. It's across the board. I think I was telling Adil this, we're very bottoms-up focused. I think sectorally, there are large pockets individually in India where you can play. And to Adil's point, to your point, I think every 3 years, 5 years, we're seeing a very lockstep jump in where markets are getting created, right? India's AI journey will be materially different to the AI journey in the US, materially different. I think the big difference between the two, in the US, a lot of the AI efficiency and the automation that is happening is a direct correlation to ROI on labor cost, right? Labor cost there, you want to hire somebody 100K, 200K per year, AI can do that for you at 20K, 30K, and therefore in India, you don't have that labor arbitrage because at the end of the day, you have power cost, you have token cost, you have all of that stuff. So that labor arbitrage may not entirely work, right? India's AI journey will be materially different. For example, we have a company in our portfolio called N-Mobile. N-Mobile is an AI supply chain automation company. So it plugs into the backend at a Maruti, at a Nestle, at a TVS, at a Bajaj. And whatever a supply chain team earlier would do manually using phone or Excel sheets, the AI will automate a lot of that stuff for you, and therefore it acts as a true assistant to the supply chain team, making it far more organized, bringing down your supply chain costs, all of that stuff, right? Anyways, logistics costs in India are at 13-14%, we need to bring it down. So the way we see playing AI in India is materially different to the way probably it gets played out in the US. We also have AI companies in the portfolio that sell to the US geography, and therefore that's a very different playbook. So it's across the board. There is no one size fits all hypothesis in the way we work.
Okay. So, but any future opportunities you want to share with our audience wherein you would further want to spend your money?
Everywhere. I think consumer is super exciting. I think financial services, as Adil said, is going through its own cycles right now. I think I'm a firm believer it will come back. It's a matter of when, not if. Consumer is skyrocketing. I think incomes are going up. I'll just leave one stat, and that's all encompassing, right? We believe the stats that are out there, average growth at a real is about 6 to 7%. You add inflation, another 4, 5, 6%, how we want to do it, 12 to 15% nominal growth, right? You go by rule of 72, you're basically saying that you have an entire India at $5 trillion, $4 trillion where we are today. In the next 7 years, we're going to add another India to it. We're going to add a full India. It's going to happen in our lifetimes. And that's going to happen once in a lifetime. It's base effect and compounding. India is the fastest growing geography. We're right now going through this anti-AI moment where everybody's thinking that India is this country where, nothing's going to happen. I think all of us on this panel have seen cycles. Let's be patient and you'll see a lot of this play itself out.
Sure. Vinod, I'll come to you. You run one of the biggest venture debt firms in India. What kind of growth you have seen and what are your expectations for the coming years? Which segments are going to play out loud?
Yeah. So venture debt sounds like an oxymoron, but actually has fit in well in the Indian ecosystem. And just as a bit of context, venture debt depends on venture capital to be available in the ecosystem, and the entrepreneurial quotient needs to be strong. In the US, it started about 25 years after equity started. So 1960s is when venture equity started, 1980s is when venture debt started. In India, everything got off to a bang about 15, 18 years ago. I've been doing this for 18 years now. So we've grown together. The learnings have been together. The success, the pitfalls, the mistakes, they've all happened together, right? So that's one unique characteristic about the Indian ecosystem. The second is the scale and ambition, right? 10 years ago, 12 years ago, the checks were more in the $1 million, $2 million range. Today, I mean, it's not just for us. Across the industry, we're talking about $15, $20 million for a particular company at a particular point of time, which was unthinkable. The third aspect is for fund managers, the access to capital. So domestic capital has come to the party. As Alteria, we are almost entirely a domestic capital fund. And that was, again, not imaginable 10 years ago. So you have an ecosystem where there's good domestic liquidity coming through. The entrepreneurial quotient is the best it's been. We've got founders coming out of startups and starting their own second or third ventures, which allows for a compression in the learning curve and makes the process more efficient for them to be successful. The dry powder across equity funds, I think, is the largest it's ever been that we've seen, at least as a country. So the question is, what can go wrong from here, right? Lots of things can go wrong. Execution is key. I think the biggest thing we tell our founders and we remind ourselves is the mistakes have to be small and the wins have to be large, right? So if we kind of balance between the two and keep learning, and a lot of the patterns repeat themselves. That's the other interesting thing. Every 3 to 4 years, a new buzzword gets created. There's a new flavor of the season. I think there was a conversation around AI. For sure, it's I would say a seminal shift in the way that we approach business, even for practitioners like ourselves. So that looks to be a step shift. But a lot of other trends keep repeating with different labels. So history repeats itself. And if we learn well from the past, I think it bodes well for the future.
Okay, sure. Piyush, I'll come to you now. You've invested across various segments, whether it's a consumer, it's tech, or AI. I mean, what are the typical areas which you look at, or when you meet an entrepreneur, what is that which actually makes you tick the box in terms of investment?
Sure. So, I think we invest across sectors, right? And within tech, different layers of tech sort of businesses, right? So for each sector or segment within, let's say, a sector, the yardsticks are different. But at a fundamental level as an investor, and this will be true for everybody here on the panel, there are 4 or 5 things that kind of have to stand out, right? So one is, of course, the opportunity size and hence the scale, wherever you are investing in, right? Second is, which is very critical to the way we operate and think, is a potential leadership position that the company can get to at maturity. Because typically, at this stage, there's a multiple re-rating that happens, right? So that becomes very critical from our point of view. Third is because we, as of now, come in Series B, which is early growth. A lot of these companies are still kind of not profitable, but positive unit economics is something that we do give a lot of attention to, because at scale, business has to be fundamentally strong. When I say fundamentally, both on the qualitative side and quantitative side. So financially, it has to make very strong sense. So positive unit economics is very critical for us. Fourth is, of course, the founders, the point that you touched upon. So motivation, I know why they are building the business, why they are into it. And second critical aspect is the long-term orientation. And the last thing you would want is to deal with a set of guys who are there in it, not for the long haul, just to kind of quickly flip it around. In that process, no, it's not a very enjoyable process, it's a long journey. So that remains very critical. Then, of course, for each sector, there are different sort of KPIs or metrics that you can look at, but that gets too deep. But broadly, these are the 4 or 5 areas that one looks at. And lastly, the risk-adjusted returns. Ultimately, as financial investors, you are there in it to make returns. So kind of everything going wrong, all the variables going wrong, on a risk-adjusted basis, do you kind of cross the kind of threshold that you're looking at?
Okay. Since we have funders and founders both on the stage, I want to ask each one of you any anecdote which you could share, of course, as investors, in terms of how you came in and helped the entrepreneurs. And Adil, again, from you, as an entrepreneur, how an investor helped you in some of the tough times.
Go ahead.
Listen, I can speak for ourselves, and I think the best example I can give you is the way we're structured as a platform, and that's how that flows into our culture, right? So as background, Sorin was set up by two guys called Sanjay Nair and Angad Banga. Sanjay used to be South Asia CEO of Citibank, and then was founding CEO and MD of KKR in India. Built KKR for over a decade before setting up Sorin. And Angad is Sanjay's co-founder. Their family runs a business in Hong Kong called Caravel Group, which is the world's 10th or 12th largest shipping fleet management company in the world. For a shipping company, they're probably the most tech-forward company that I've come across, because they have a full-fledged tech team sitting out of Bombay, setting up tech for them. And Sanjay's wife, Falguni, is the one that built Nykaa out of India, right? So both these families have seen large businesses getting built out, right? From startup all the way up to, exit and beyond. And so I think the entire philosophy was, can we bring a very differentiated offering to founders out there from practitioners who built this and done this before? And so we're structured very differently in that sense. We ensure that we spend a lot of time with our portfolio companies. It's not just we deploy capital and then we leave it to them. We open our entire Rolodex to our portfolio companies, help them with hiring. We help them with getting involved in seeing what stuff is working and not working. I mean, I can say a lot of things, but I think, if each person actually picks up the phone and speaks to our founders, let them be our ambassadors as opposed to me topping this. But yeah, I think that's where we get involved. I think India is a very, very different market compared to the US in terms of buying behavior. And therefore, that little bit of help that goes down in helping these companies open doors plays a key role. And that could be customers, it could be hiring, it could be, a whole bunch of other things.
So I was thinking it's actually a very important question, because either when we're talking to LPs and we raise money as well, or we're talking to investors in other case, the first question is, how are you different, right? And the market and macro and all is fine, but how are you different, right? And today we live in a day and age where there is massive amounts of information. There's referencing digitally, physically. I think there's actually places that you can find online where VCs are being rated with names, right? It's no longer anonymous anymore. So there is no hiding, is one thing, right? Whoever you are in this ecosystem, I think the reality is now getting more and more visible. The second thing is the best outcomes happen from exceptional situations, and it's the power law again. So 20-30% of your portfolio is going to create the maximum alpha, and that 20-30% will always have a lot of choice. So those founders, those companies, those funds, whoever you are in that 20-30% of excellence, you will have a lot of choice. So whether you're a fund manager providing capital, or an LP providing money to a fund, or a founder raising capital, if you have choice, then there are some markers that one will look for, right? From an equity perspective, I think Subeer talked about that too, which is the extent of the network. Are they really there when it's a difficult situation for the founder? Is it a conviction bet? Is it backed by numbers? It depends on the stage, depends on the hypothesis of the fund as well. From a debt perspective, it's an even harder question. From a premise or a standpoint of what we're supposed to do, our capital is supposed to help a company grow. But if the company is in deep distress, then the risk that they need to be met with is actually maybe equity capital. So the first thing that we have to explain and educate is, when you're about to have a really difficult time, debt is actually going to make it worse. And oftentimes it's the other way around. People say, you know what, I have 1 month of runway, and hence, can I just get a bridge? If you don't tide through, the debt will actually kill the business. So this statement took a lot of time to embrace, to educate, to ensure there's enough awareness. And the counter for that is then, is it the convenient option that the company is comfortable, and does it add anything to the company? I'll give one anecdote on that, which is Spinny, which is one of the companies that we had backed almost 7 years ago. And when Spinny was raising capital, then it was maybe the 5th player. There were other companies which were much further ahead. But the thing that Neeraj was doing differently was actually buying a car and selling it, and not just having a classified or listing or selling to a dealer. So it was a difficult premise. It was an execution challenge. And he raised $10 million of venture equity from 2 very renowned funds. And the dilution that it created was significant, because it was asking for a fifth player in the segment. The attractiveness was, of course, very different then. And the debt that was provided at that time, today the company is worth $1.25 billion. It's the market leader by a mile. Saved the founders double-digit million dollars of dilution. So if the company does extremely well, then venture debt works well. If the company does extremely poorly, it doesn't do anything much for the business because the outcomes are visible. In the in-between zone, it works just as debt because there's no equity upside. So there are three buckets that we look at outcomes. And the first one is the most obvious, and maybe the third one as well, but it's the fat middle, as we call it, which is most of India. Where most Indian startups are in that fat middle, where they've done fine, but are they cutting through to the top 20%? That's the question.
And just to add, I think Adil will agree with this. See, our belief is for real credible founders of businesses, there's no dearth of credible capital. So credibility from that point of view is just a table stake today. So what really matters to any founder over there is, A, as an investor, how well you understand and appreciate his business. Second is, what kind of value can you bring beyond capital? Now that value can, of course, be in the form of, which Subeer mentioned, and every investor kind of does that. Or also it can be in the form of very tactical advice, right? Because these companies are in a very high growth phase, right? So I think for really good, credible kind of businesses over there that investors chase, it's not just about capital, it's about what you can really bring beyond capital. And a lot of conversation actually happens in that direction when actually any investor is kind of investing into these companies.
Yeah, so I'll pick up on what Subeer said, saying all of us on this table would have great anecdotes, right? I'll give maybe a few quick anecdotes. So I remember, we were speaking with an investor, and then I told my board about it. And one of them said, oh, he's my best friend, right? I'm going to put in a call. And what I realized at that minute, right, is the quality of your relationship with your investors at the end of the day is going to make or break most of what is getting built out. So literally that one phone call gives the comfort that, hey, listen, this is kosher, right? The second example would be, we have an investor called Experian. They run a large data, credit services, and consumer business. And we were in a meeting last month where they had their Brazil head talking to our India head, discussing how to build a product out. So that is an example of how an investor can help. The third is, right, as an entrepreneur, very often you're going to things for the first time, but your investor has seen it 50 times, right? So we'll go tell the investor that I'm thinking of this transaction, what do I do? They'll be like, hey, here's the banker, here's the lawyer, sit down and figure this out, right? So I think it really is a very, very high value relationship, provided it works well. And the key to it, right, is you'll have ups and downs. It's very easy for it to work well when everything is great, but to be able to manage through the entire process, right, I think is a skill.
Imagine starts good 2.5 years prior, because these companies are typically in a journey. Like initial part of the journey is all about product market fit, then you get to building the system processes. Before you think for an IPO, a lot of governance, a lot of things have to kind of fall in place. So I think that process is going on. And secondly, I think IPO is also a function of what kind of market cap that you're looking at. Because practically what happens is public market behaves very differently to a private market does. So you need a certain threshold from a market cap that gives you certain kind of flow, that attracts certain kind of investors who come and do it. So a lot of preparatory work happens in that direction. So I think a couple of our companies by 28 will go public.
So interestingly, before this panel, I was on a call with one of our portfolio companies, which is looking at listing 2 years from now. And the conversation was actually what they need to prepare for this year, right, this quarter, literally. So the first thing is what we see manifest. The work has happened few years behind, and it's a trek. We had the good fortune of partnering with Bluestone, Aether, Kist, which all got listed recently. And one is the company's preparation, having all the ducks in a row, and that's not an easy thing in the first place. The second is the market itself. Just when you feel you're ready, some war breaks out somewhere, everything gets pushed out by 6 months, and sentiment gets muted. You can't control that. It's in fact not just the listing path. I was just thinking about the question, even if a company is at a Series B today, the difference that we are seeing in the conversation is there's a percolation of, okay, what is the end state value? What is the expectation on governance? What is the expectation on internal processes? And that is actually percolating through to even a Series B. And that, I think, is the best news possibly. It's not just about the liquidity. We're all happy that there's liquidity getting created. Hopefully prices can be better. But it's more the system that it's creating with even younger stage founders. If you eventually want to get there, why don't you start today on some of the process that you need to have? And just the approach. What are you building towards? There's no room for, I will just keep burning, till the cows come home. I think that ship has sailed. Right? So if you have to get leaner and hopefully meaner, you can't start 3 years from now. Right? It's a starting point today, and you prove it stage by stage, and that longevity creates even higher value. And that recognition is definitely, it's quite palpable.
So we're the new kids on the block, right? So we made our first investment in April of 23. So I don't think we're there in terms of any of the companies going public. But from my previous stints at Mayfield, I think Amagi Media went public in Jan this year at 8,500 crore market cap. One of my ex-portfolio companies, which was Leap India, which is a wooden pallet rental company, has filed with SEBI. So we've seen some of these cycles and a lot more that will come from that portfolio because a lot of those have matured over a period of time. Here, we have some time, we have patience.
Thought which comes to mind, without the core passion, energy and mission, there are no numbers. So the numbers are a consequence, and the numbers are important, but they're a consequence. I think 2-3 things are evolving because a lot of funds in India are also entrepreneurial now, including ours and many others. So we are also fundraising, setting up a company. So there's a lot more empathy. That is the first thing. There's a lot of appreciation for the journey because we are going through the same in some sense. It doesn't get captured in that way, but it's a similar journey on company building, fundraising, and managing that. But I don't think there is an equivalence in terms of the mission. It's not either or. It's not the mission, the hunger, the passion, or the numbers, the math, the outcomes. It's both and lots of both. I would say that's the key from my perspective.
If I may add, actually, if you think about this, it's always good to have a different perception. See, founders inherently would be very imaginative, right? That's how business is getting built. At the same time, investors bring some level of prudence. So when there is a difference of opinion, the idea is it's a collective win or lose, right? I mean, if company does well, both investors gain and founders businesses get built. So it's always finding the middle point where that imagination meets some sort of prudency. So that is where the best kind of outcomes come in.
I'll put it slightly differently for you. I don't think necessarily it's investors and founders not understanding each other's language. I think I'll give you a different analogy and join it back, right? When you're going and selling to your customers, right? And you can tell me when you have understood your customer's pain point and you have aligned your product, offering, pricing, the entire package deal to the customer, the propensity of the time period to sell probably shrinks, right? Why is that? Because there is alignment of interest between what you are offering and what the customer wants. Apply that same analogy to an investor and a founder, right? You align what you're trying to do with also understanding what is the business model of the investor, right? You're running a business, you have passion, you're doing that. As fund managers, we have passion in what we do for a living. But we're also running a business. In running that business, I'm answerable to my shareholders, which are my LPs. I have to generate a return and give it to them. And therefore, that package deal has to fit what you are offering as to an investor versus me investing versus me taking it back to my investors, right? Once you have that alignment through and through, I think everybody understands language.
So I think one is, of course, the persistency. I think like you're a founder, right? I mean, you have a vision, you are chasing a certain kind of dream. Second is, I think when you reach out to investors. So I think what is very important, and Adhil would kind of agree with that. So I think the best thing would be to figure out who are the investors, who understand health tech or health in general very well. So the ability and the probability of they appreciating what you're building is far better than you going and educating somebody about health when they've never invested in it. So I think just be a bit practical about make that list A, which is the high probability investors, very active in health. Second is in the broader category of investors. Thirdly, I would say, while of course you speak to VCs, at the same time, there are a lot of these angel networks, etc., right, which pull in money from HNIs. So there's another bucket that you should keep active. So you should always have that plan A, plan B, because for the idea for you would be to get money and get started with building the business, right? And as the business scales up, right kind of money will follow. So I think that's the approach I would suggest you should take. So thank you, everyone. I think just one parting mark. While we have seen the whole Indian startup ecosystem, our belief is the next phase of Indian entrepreneurship will be actually a lot more bolder and will be a lot more ambitious. So I think very interesting times ahead for Indian startup ecosystem.